Well, a very warm welcome today to my portfolio updates section for our online masterclass this year, which we're very happy to be able to put up on our YouTube channel. Now, over the next half an hour or so, I'm going to take you on a journey where I'm going to challenge the worries that maybe some of our clients have at this time. It's been a bit of a nervy few years, hasn't it, for investors? And indeed, although we've made money, it's been a bit disappointing, probably only making as much really as a high rate savings account. Why is that? Let's have a look at why, and let's have a look at, is it really worth it still? So the question that many people will ask is, well, why bother investing? I mean, the last few years has been pretty flat. What's the point? Actually, if we go back a bit further in time, history teaches us a very good lesson. Now, this chart has been very kindly lent to us by our friends at Brooks Macdonald, and they have conducted some really fascinating analysis where they have looked at what would happen if an investor were to invest £100,000 back in 2000. Now, in the year 2000, I was a young advisor. I'd been advising for a couple of years by then. And you can see how if the money was left invested in the MSCI World Index, which is just a collection of global indexes, it really climbs. Now, this is obviously no guide to the future, but it does show you how historically that £100,000 becomes worth around £400,000 when left purely invested for 25 years. But that's not human nature, is it? Because what can happen is that sometimes people don't just want a bit of their money, they want to take it all out and then try and put it back in again. And the reason behind this is usually driven by fear. And I've had many clients over the years who've asked the question, well, why don't I just take it all out when things are going badly, and then I'll just invest it when things are going better? The trouble is, we can never see when it's going to get better. It just does. And when it's got better, it's just too late. In fact, it's often a relief for the investor when they take the money out. They feel great because they're out the market. They can watch it carry on tanking down for a bit. But then when it recovers, it's absolute torture because they can't work out whether this is a false dawn or is this the real thing. And so it's very ill-advised. Now, our friends at Brooks Macdonald have gone further. They've done their maths and they've worked out with that grey line, the second one under, how if you had come out of the market and missed just 10 of the best days, the difference there is staggering in returns. And look at the next line down. If you miss the 30 best days and even the 50 best days under that, it becomes a very different proposition. So what Brooks Macdonald have then gone on to do is they've gone on to show the annualized returns that an investor would have had they remained invested for 25 years in the MSCI World Index, and it would have been about 6.1% per year, which would have been very pleasing over many years of low interest rates. Here you see, though, if they'd missed the 10 best days, their returns would be crushed down to 4.1%, which is really interesting. But look at this. If they missed the 30 best days, they're down to just 1.1% per year, hardly worth doing, really. And then if they'd missed the 50 best days, it's even more grim news. They've actually made an annualized loss of 1.2% per year. So the moral of the story is you've got to be in it to win it. When you're going into investing, remember it's for the long term and it's about sticking with it. Now, what's our process? Well, our process is very much about diversification. We don't believe in having everything targeted at very narrow asset classes because we don't want to make our clients huge losses if we've made that call wrong. We stick to diversification that was first really borne out by this man. Here is Mr. Harry Markowitz. In his older years, he passed away a few years ago. Now, Harry Markowitz was famous as an American economist for coming up with something called the efficient frontier theory. Harry argued that you should never have all your eggs in one basket because if the basket goes over, you break some eggs. And what Harry argued really was that through simple mathematical calculations, you're able to show that by having negative correlation In other words, something's going up when something's going down, you're able to better protect your clients' investments from a catastrophic fall. Now, this will also, of course, play on upward performance because it means you haven't got everything in the right basket when it goes flying up. But similarly, by having lots of different baskets, you tend to, over time, get a much more measured, calm, and very often a better result. Let's talk a bit more about that negative correlation, shall we? So here, Harry Markowitz came up with the idea of the efficient frontier planning. This is a simple chart which shows you a scatter chart of different red dots. And those different red dots are different funds with different performances. You can see the returns on the left-hand side, the axis that goes vertically. So in other words, the higher up the chart those little red dots are, the better they've performed. And then you can see the risk running from left to right. In other words, the more to the left they are, the less risky, the more to the right, the higher risk. And you can see how generally, as you've got more risk, you've got more return, and you also get this kind of gathering of spots right in the harder, sort of heavier area there. The idea of efficient frontier planning is to try and get the best return you can, but whilst controlling the overall risk. And we do that through negative correlation. So here's some examples of negative correlation. Let's imagine, folks, we have a beautifully hot summer. And so we go out and everybody buys ice creams. Nice chocolate ones. I'm into my chocolate ice creams. However, and I apologise about this next photo, we couldn't afford to pay for any others. We could have a wet summer, and so we might be hiding under umbrellas. Now, what on earth am I getting at? Well, if we've had a really hot summer and we've bought ice cream shares, we will do really, really well. But what happens if we bought umbrella shares, expecting it to be a very wet summer? So the idea of negative correlation is, as an investor, we buy both ice cream shares and umbrella shares to sort of hedge our bets, as it were. Now, this is only a small example, but this is really what underpins the theory of diversification. So I'd like to now focus on 4 out of our 8 portfolios. I haven't picked them as favourites. In fact, I've just tried to pick them broadly as examples. I just want to reiterate that this is not a guide to future performance, and we are not in any way saying that these are the best portfolios. It's just these are the portfolios that many of our clients have, and so I wanted to just touch on some different ones to try and show some different things. Now we've got here our level 2 portfolio. For those of you who aren't aware, we run risk from 1 to 5, with 1 being our most cautious portfolio and number 5 being our highest risk. This is some data from Financial Express, powered by Financial Express, on the UScan report, which we can lift from Quilter, where most of our clients' money is held up on a platform. The green line is our level 2 model portfolio, and the red is an average of all the portfolios in this particular sector that have a similar makeup of equities to bonds. In other words, 20 to 60% shares, the rest then being in bonds and cash. Now, this is a comparable, it's not an exact, so it's the best we can get. But we can see here the green line moving around, and can you see those green dots? Those green dots are where we've made adjustments to our clients' portfolios to be proactive, to perhaps maybe wash out 1 or 2 funds that we're not happy with, or it could be to adjust asset allocation tactically to keep up with what's happening in the world. Now, the thing that stands out for me is that level 2 portfolio is slightly spikier than the red line. And so recently we've actually softened that portfolio, adding in some more cautious funds. But you can also see that over the 5-year period, it has outperformed its sector average, which is really encouraging. And indeed, over the last year, it's done it as well. So that's very, very encouraging indeed. Let's have a look at another one. So this is one of our ethical portfolios, and we call this the PE4, the Pro Ethical 4 portfolio, which is our highest risk ethical portfolio. Now this is really interesting to look at. Again, the green line over the red. Now it's a bit of a difficult one, this one. We've picked the highest risk of average sector, which is 40 to 85% shares as a comparable. However, the PE4 has 100% shares, so it isn't quite a comparison, but it's as close as we can get. And you can see how in the first few years, look after COVID, how that green really shot up. And there was a lot of feeling at the time about renewable energies. The Magnificent Seven stocks were doing so well. And you can see that green really taking away because we have quite a lot of that in the ethical portfolio. Things like oil and armaments and so on weren't doing so well. That's really changed in the last few years. And you can see the red line catching up. The ethical can't hold those things. And that's why I wanted to show this slide today. Again, it's a little bit spikier, and again, we've worked to soften it, but it's very encouraging to see how over 5 years it has outperformed the sector average. Again, that's no guarantee to the future performance, but it's good to see. What's really encouraging is actually to see how over the last 6 months, this portfolio is starting to pull away again from portfolios that would contain oil and gas and arms and tobacco and so on. And that's something that's really encouraging us. However, this work has been done at the beginning of June in preparation for our masterclass. And of course, just before, sadly, bombs have been dropped again in the Middle East. So maybe things will be a little bit different for a while, but it's good to show how in the right environment, things have some legs on them. However, I think it's only right that we also pick on our worst portfolio over the last 5 years, and that is my beloved level 4. So the level 4 mainstream portfolio used to be really in a wonderful place. And in fact, if we ran this data further back, you would see how well it did. Even in the first few years of the last 5, you can see that green really sitting above the red. Now, again, it's compared against a 40 to 85% share average. The level 4 mainstream portfolio doesn't have any bonds, a little bit of money market cash in there, but not much. So it's the best comparison we can get. Now you can see how in the first couple of years after COVID, it was still doing really, really well. Then it got caught up, I suppose, and then it actually got left behind. And in the last few years, it's underperformed. And in fact, that's meant that over the 5 years, it's underperformed the average, not by a huge amount, I hasten to add, but it has. Why is that? Well, you can see despite our green dots and lots of work going on, effectively the methodology of this level 4 portfolio is to try and hold emerging markets, Asia, offshore equities and so on, and more specialist, smaller companies as well, potentially within the UK and Europe. All of these things have really struggled during a time of a higher, stronger US dollar and higher oil prices. Things do appear to be changing, and again, look at the encouraging signs over the last 6 months. I know it's not very long, but you can see how the 6-month returns on the model portfolio is actually to be up when the average for the sector is down. And indeed, over the last 3 months a month, it is better. So I am encouraged. And yes, I realise the world is a very rocky place, but I think this underdog actually deserves a bit of love and affection, because I think that it will be quite an exciting place to be. Obviously, that's not a recommendation, though. You need to be talking to us. But for our level 4 clients, don't be too discouraged. Finally, we ought to look at the superstar. So again, not a recommendation to buy. This is not for everyone. This is our level 1, our most cautious portfolio in green over the red of the average. And it has actually a very, very similar makeup to the sector average. And you can see it is a bit spikier. So we've pushed the boundary a little. And in fact, we've recently put more cash into this level 1 to try and soften it and what have you. But look how it has pulled away, almost really doubling the sector average over 5 years, which is really reassuring and nice for us to be able to deliver to our clients. And indeed, over the last 6 months, again, a similar story as it sort of profits, I suppose, from a weaker US dollar. So nice to see. Now, I now just want to talk about a couple of things we did back in our reviews at the end of last year, just to sort of finish off our presentation today. And I'm moving at good speed, so hopefully I haven't sent you to sleep yet. Now, for those clients who've had our portfolios for some time, you will remember we had the AXA Health Fund in our level, it was level 2, 3, 4 and 5 at one point. We started to get rid of it though last year for our clients, and it isn't because this fund suddenly became bad. This is just where we're trying to show we are trying to study what's going on, and we're considering the world around us. Now, of course, a little known character called Donald Trump took over as president towards the beginning of this year. We knew that was happening in our December proactive reviews, and so we made the decision to come out of the AXA Health Fund. And that was, at the time, a bit of a worry for us because we like the fund, but ultimately we were really concerned at the time by the outlook in America, particularly for pharmaceutical companies. Would the Trump administration undermine the sort of the free Medicaid, and would there be problems for this type of stock? And so we came out, and it fell about 14.5% after we came out. So that was a positive bit of news. We then put the money into the Lazard Infrastructure Fund. Again, this is not a recommendation to buy this fund, and things will change. But this was an interesting fund that we chose because of the new world we appear to be entering, where possibly roads might need to be rebuilt, where possibly electric grids might need to be redeveloped, and so on. And that fund has risen by almost the same amount as the AXA fund fell by. So it replaced something, and it did really well. For us, this doesn't mean that we're geniuses, we're not magicians. This was just something to celebrate. And this doesn't, in fairness, this doesn't usually happen quite as well as this, not by a long way, but this was really, really nice to see for our clients. It helped a lot. But let me just show you then perhaps a story of more modest things. This is the Lion Trust UK Smaller Companies Fund that we'd held for years. We finally decided in December to call time on it for now, and this is within our level sort of 4 and 5 portfolios. We felt that the environment within the UK after that dreaded October spending review by the Chancellor and the budget, we were concerned. We felt that really it was not looking good for smaller companies, and so we pulled the plug. We were happy that we went into something else, and that was just a FTSE 100 tracker. But actually we watched as the fund fell, but then look how it went back up again. And actually it is still slightly down on when we came out, or at the point of certainly producing this analysis and these slides, but only by 1.7%. However, what we went into then was the L&G UK 100 Index Trust, which is just a tracker. I'm not a huge fan of trackers. They can often track a market downwards, but within a well-diversified portfolio, it sometimes does pay for us to have a few in there as a blended style, gets the cost down a little bit, and look at that, it's up by about 7.7% over that time. So again, it was a move that paid off, but just not to such exciting proportions. So normally this is the point where I would say, do you have any questions? And then I sweat as you throw them at me. If you do have questions after looking at my little presentation today, and you think there's anything at all that you'd like to ask, please just pick up the phone or email me. And phone calls are lovely. You know, we can chat this through. And if there's anything at all that I can help with, please just ask. Obviously, we're putting up the usual warnings, which are very, very important. And I do really want to reiterate this. This is not a promotion, this video. This is just for our own treasured clients to help you with understanding a little bit more about what's been going on under the lid of our portfolios. So until next time, all the very best.